Hi students, today we are starting a new module in our syllabus that is related to ratio analysis. First of all, we are discussing what is a ratio. Ratio is the quantitative relations between two or more figures. For example, we are finding the relation between sales and profit. So we may say profit is 10% of sales. So it is the relation between sales and profit. So the relation between two figures are called ratio. In ratio analysis, if we are using the financial statement details, such ratios are called accounting ratios. It may be expressed, a ratio may be expressed in different ways. Mainly there are four ways of expressing ratios. First one is as percentage. For example, we will say the sales is 10%, 5%, etc. Okay. Then the second one is proportion. It is also called pure ratios. For example, 2:1, 1:3, 5:4, etc. Okay. It is called pure ratios or proportions. And the third one is rates or times. We will say profit is 10 times as compared to the net profit, or the sales is 5 times as compared to the capital amount. We will express it in times. And the next one is fractions, 0.10, 0.20, 0.50, etc. In fractions also we will express ratios. An analysis of financial statements with the help of ratios are termed as ratio analysis. It is defined as the process of calculating and interpreting various accounting ratios for arriving at conclusions about the financial position, performance of the enterprise, etc. We can define ratios like this. We are discussing the next topic, that is objectives of ratio analysis. Okay, there are different objectives. The first one is to study the short-term solvency of the business. Short-term solvency means the liquidity position. We have to analyze what is the current liquidity position, the ability to meet short-term requirements. For this purpose, we are using liquidity ratios. And the second one is to study the long-term solvency of the business, the long-term capacity, the relation between debt and equity capital, the leverage of position of the company, etc. Then the third one is to interpret the profitability. Even if we are having profit, we have to identify what is the percentage of profit, what is the percentage of gross profit, or what is the relation between net profit and sales. All these can be measured with the help of ratios. Then to measure the performance, we can measure the performance of the business in terms of the ratio analysis. Then to facilitate financial forecasting, ratio analysis help to forecast for the future sales. We can express what is the profit now and what will be the profit after 4 years or 5 years. What is the gross profit next year? All this can be measured. Then to facilitate comparison, we have to compare our data with the data of other firms. We have to compare this year data with the data of next year's. All these are possible with the help of ratio analysis. Then next one is to communicate the strength and weakness of the company. All these are some of the objectives of ratio analysis. Then the next area is steps in ratio analysis. There are different steps in ratio analysis. Mainly it is classified into four. First one, selection of data. First of all, we have to select a data from the financial statement so as to facilitate comparison. The next, second one is calculating ratios, finding ratios. We are calculating ratios. Third one, compare ratios. We have to compare the ratios with that of previous year, with that of another firm, etc. Okay. Then last, interpretation of the data. We have to interpret, give a conclusion as to what is the position, what is the performance, etc. Okay. Then there are different ways of ratio analysis. One of the way is single absolute ratio. We are simply finding a ratio, gross profit ratio, net profit ratio, etc. Then the second one is group of ratios. a group of ratios can be used for analysis. Then the third one is historical comparison. We can compare our data with that of the previous years, historical comparison. And another one is standard ratio with actual ratio. We can compare our actual ratio with a standard ratio. For example, we can set our current ratio, we can calculate our current ratio, and it can be compared with a standard current ratio. Then we can have an evaluation of our performance. Then inter-firm comparison. We can compare our firm's ratios with that of other firms. All these are the ways of ratio analysis. The next topic is different uses of ratio analysis. One of the first and primary objective use of ratio analysis is managerial uses. Management is the main party using ratios. Managerial use includes, first one, help decision making. It helps the decision making of the company. Then it helps financial forecasting. Management can forecast the data for coming years. It can help planning. It helps communication. It helps management for communication purpose. It helps in coordination. Business can be coordinated with the help of financial information. Then it helps control. The firm can be controlled. Then the second use is the utility to shareholders. Shareholders or investors are the main parties using ratios because they have to make a good investment decision. Better investment decision can be done with the help of information that is available from ratio analysis. Then utility to creditors. Creditors have to analyze our liquidity position. Then only they can give more and more credit to the company. So creditors are the parties using ratio analysis. Then next, utility to employees. Employees has to identify the current position of the firm. Then only they can plan in whether they have to continue in the company or not. So employees are using. Then utility to government. There are different government departments depending on company data or ratios. And also mainly there is tax audit requirement. The taxation department, they have to collect tax based on the performance of the companies. So taxation department is having uses. These are the uses of ratio analysis. One more small topic is limitations of ratio analysis. One of the limitation is limited use of a single ratio. A single ratio, for example gross profit ratio, it does not communicate anything. It is simply giving an information. So single ratios are having some limited use. Then lack of adequate standards. There are a lot of standards, a lot of ratios, but all the ratios are not having standards. Some of the ratios are having standards. So if there is a standard, we can compare our performance with the standard. If there is no standard, nothing can be done. So lack of adequate standard is another limitation. Then inherent limitations of accounting. We are calculating ratio based on information we are getting from accounting. If the accounting is having limitations, our ratios are having also limitations. Then changes of accounting procedures. Companies are changing accounting procedures. If there is a change, we cannot compare this year percentage with that of last year's because the procedures of accounting has been changed. Then window dressing. Companies always manipulate their accounts. If we are calculating ratio with the help of manipulated data, that ratio will do nothing. It will be having no fruits. Okay, window dressing is another limitation. Then next limitation is personal bias. Personal bias from the part of the analyst. Then incomparable. Ratios are not comparable because different firms are using different methods. A single firm may be using different methods in different years, etc. So it is incomparable. Then the next one is absolute figures are distortive. Okay, absolute figures are distortive. It cannot be dependent. Always we cannot dependent. Okay, then price level changes, inflation changes. like there is changes in the inflation rate, so this year's 1 rupee will not be having the same value if it is getting next year or next year's or previous year or last year's. The time value of money is changing due to inflation or price level changes, so we cannot compare 1 year data with that of previous year or next year's. Okay, then ratios are not substitutes. Another limitation, we cannot substitute ratio for management decision making. Management decision making is the process to be done rationally. Okay, these are the limitations. So I just have given you an introduction of ratio analysis.